The Federal Reserve just made a move that most Americans have not yet noticed. But history shows the ones who notice first are the ones who protect themselves first. Because every time this has happened before, gold moved, silver moved, and fortunes were quietly rewritten. This is not speculation. This is a pattern that is repeated for over a century. And by the end of this video, you will understand exactly what is coming next. Stay with us. Welcome back to Precious Metals Intelligence, the channel built for people who prefer to understand the economy before it moves, not after. Whether you have followed this channel for years, or this is the very first video finding its way to you tonight, you are exactly where you need to be. If you find value in the way we break down these events calmly, clearly, and without the noise so common elsewhere, consider joining the Precious Metals Intelligence family by subscribing. It costs nothing, and it simply ensures these briefings continue to reach you when they matter most. Before we begin, we would love to know, where in the world are you watching from tonight? Drop your city or country in the comments below. It always means a great deal to see just how far this community truly reaches. It started, as these things often do, with a single statement. The Federal Reserve released its latest policy update, and on the surface, it looked routine. A few sentences about interest rates, a brief mention of inflation, nothing that seemed at first glance like breaking news. But for those who pay close attention to how the Fed chooses its words, something felt different this time. The tone had shifted. For months, the Fed had spoken with a certain confidence. Inflation was cooling, they said. The economy was stable. There was no need to panic. But in this latest statement, that confidence was harder to find. The language was more cautious, more guarded, the kind of language people use when they know more than they are saying. Analysts who study these statements for a living noticed it almost immediately. They pointed out that certain phrases had quietly disappeared, while new ones had taken their place. Words like transitory and under control were replaced with softer, more careful phrasing. To the average person, this might mean nothing, but to those who have studied Fed communication for years, this kind of shift is rarely accidental. The Fed does not speak carelessly. Every word is chosen with purpose. And when the tone changes, it usually means the situation behind the scenes is changing too. Within hours, financial markets began to react. Stock prices moved, bond yields shifted. And in the background, away from the headlines that usually dominate the news cycle, something else was happening. Gold and silver prices began to stir. This is not unusual. In fact, it is one of the oldest patterns in modern finance. When the Fed signals uncertainty about the economy, investors start looking for safety. And for centuries, gold and silver have been the first place people turn when trust in paper money starts to weaken. It is a simple idea, but a powerful one. A dollar is only worth what people believe it is worth. It has no gold behind it anymore, no silver, nothing physical holding up its value. Its worth depends entirely on confidence. Confidence in the government, confidence in the central bank, confidence that tomorrow's dollar will buy roughly what today's dollar buys. When that confidence wavers, even slightly, people start to look for something else, something that has held value for thousands of years, long before any central bank existed. That is why, throughout history, moments like this one have often marked the beginning of major shifts in the price of precious metals. This is exactly why so many people are paying close attention right now. Because this is not the first time the Fed has changed its tone right before a major economic shift. It has happened before, more than once. And each time, the pattern looked strikingly similar. A quiet change in language, a brief period where nothing seems to happen. And then, a much larger move that catches most people by surprise. The people who understand this pattern do not wait for the big move to happen before they act. They watch the early signals. They pay attention to the small shifts in tone, the subtle changes in wording, the quiet moments before the storm, because by the time the shift becomes obvious to everyone, it is often too late to prepare. Right now, many economists and analysts believe the country may be standing at one of these early moments. The Fed's latest statement was not loud, it was not dramatic, but for those who know how to read between the lines, it carried a message that is hard to ignore. Something is changing. The question now is not whether this shift will affect the broader economy. History suggests it almost certainly will. The real question is how large that shift will be and how quickly it will unfold. To understand what might happen next, it helps to look backward. Because this is not the first time the Federal Reserve has stood at a similar crossroads. Decades ago, a very similar pattern played out, and the results reshaped the financial world for years afterward. That story holds important lessons for what may be coming next. History rarely repeats itself in exact detail. But it often rhymes, and for those who study economic cycles closely, the rhyme happening right now sounds very familiar. To understand what may lie ahead, it helps to look back at a period many economists still study today, the late 1970s. At that time, the United States faced a very different world, but one strange similarity linked it to today. The government was spending heavily, the dollar was weakening, and the Federal Reserve found itself trying to manage a problem that seemed to grow faster than its solutions. Inflation was rising quickly during those years. Prices for everyday goods climbed month after month, and many Americans watched their savings lose value in real time. The Fed, led at the time by a small group of policymakers trying to restore order, went through a similar pattern to what analysts are now seeing again. First came cautious language, then came policy adjustments, and eventually the Fed was forced into much larger action than anyone expected. During that period, gold prices did something remarkable. In just a few years, the price of gold moved from around $35 an ounce to well over $800 an ounce. Silver followed a similar path, climbing dramatically as investors searched for protection against a currency that seemed to be losing its footing. People who recognized the pattern early and who moved their savings into precious metals before the surge protected their wealth in a way that paper savings simply could not match. That was not the only time this pattern appeared. Fast forward to 2008. The global financial system faced a crisis unlike anything seen in decades. Major banks collapsed, markets froze. And once again, the Federal Reserve stepped in, this time with a tool that had rarely been used at that scale before, printing large amounts of new money to stabilize the economy. This process, often called quantitative easing, flooded the financial system with dollars. At the time, many believed this would solve the crisis quietly without major consequences. But in the years that followed, gold prices surged once again, eventually climbing past $1,900 an ounce by 2011. Investors who understood the connection between money creation and metal prices were once again ahead of the curve. Then came 2020. A global pandemic forced economies to shut down almost overnight. To prevent total collapse, the Federal Reserve responded with the largest monetary expansion in modern history. Trillions of dollars were injected into the economy in a matter of months. And once again, gold and silver responded. Gold reached new all-time highs. Silver, which had been overlooked for years, saw a sudden and powerful surge in demand. Each of these moments shares a common thread: a period of financial stress, a shift in Federal Reserve language and policy, and a rush of investors turning toward precious metals as a way to protect what they had built. This is not a coincidence. It is a pattern rooted in basic economic logic. When a government creates more money, or when trust in that money weakens, the value of that money tends to fall over time. Gold and silver, on the other hand, cannot be created out of thin air. Their supply is limited. Their value has held steady across centuries, empires, and currencies that no longer exist. This is why so many analysts today are drawing comparisons between those earlier periods and the current moment. The similarities are not identical, but the underlying forces feel familiar. Rising government debt. A Federal Reserve caught between slowing the economy and avoiding a deeper crisis. And once again, a shift in tone that suggests policymakers are preparing for something bigger than they are willing to say directly. Of course, not every warning sign leads to a major shift. Markets are complex, and no analyst can predict the future with complete certainty. But history has shown time and again that when these specific conditions align, the outcome tends to follow a familiar direction. That question leads directly into something many investors are missing right now: a signal hiding in plain sight, one that most mainstream financial coverage has largely ignored. While most people focus on interest rates and inflation numbers, a quieter signal has been building in the background. It rarely makes headlines. Yet those who track it closely say it may be more important than anything the Federal Reserve has said in its official statements. That signal is central bank gold buying. Over the past few years, central banks around the world have been purchasing gold at a pace not seen in decades. Not the Federal Reserve itself, but other national banks in countries like China, India, Russia, Turkey, and Poland. These are not small purchases. Some years, central banks collectively bought more than 1,000 tons of gold. That is an enormous amount, especially coming from institutions that typically move slowly and cautiously. Why does this matter so much? Central banks do not buy gold on impulse. They do not chase trends the way individual investors sometimes do. When a central bank adds gold to its reserves, it is usually making a long-term decision about trust. Specifically, trust in the US dollar as the world's primary reserve currency. For decades, most countries kept the majority of their reserves in US dollars. It was considered the safest, most stable choice. But that assumption has started to shift. Some countries have grown uneasy about relying so heavily on a currency controlled by a single government, especially one carrying record levels of debt. So instead, many have quietly begun shifting a portion of their reserves into gold, an asset no government can print, freeze, or control. This shift has been happening gradually, almost silently, while most public attention stayed focused on stock markets and everyday inflation numbers. But analysts who track global reserve trends say this slow movement may be one of the clearest warning signs available today. Here's the part most people miss. Central banks tend to move well ahead of public sentiment. By the time everyday investors start paying attention to gold, central banks have often already been buying for years. This means the recent surge in official gold purchases may not be a reaction to today's headlines. It may be preparation for something still ahead. There's a second overlooked signal as well, one tied closely to what is sometimes called real yield. Real yield is simply the return an investor earns after accounting for inflation. When real yields are high, holding cash or bonds feels safe and rewarding. But when real yields fall or turn negative, holding cash starts to feel like a losing position. Money sitting in a bank account quietly loses purchasing power every single day. Right now, many analysts point out that real yields have been trending in a direction that historically favors gold and silver. It is a subtle shift, easy to miss if someone is only glancing at headline interest rates. But those who study the relationship closely say this single factor has been one of the most reliable predictors of major moves in precious metals prices throughout history. So why do most people miss this? Part of the reason is simple. Mainstream financial media tends to focus on short-term drama. Daily stock swings, breaking news alerts, dramatic predictions designed to capture attention for a few minutes before moving to the next story. Slow-moving trends, like central bank gold purchases or shifting real yields, do not generate the same kind of excitement. They unfold over months and years, not hours. And because they build quietly, they are easy to overlook until the shift becomes too large to ignore. But history suggests that the quiet signals often matter more than the loud ones. This is not a claim that gold or silver prices will rise overnight, or that anyone can predict the exact timing of a major move. No credible analyst would claim that with certainty. Markets are complex, and short-term prices can be unpredictable, but when multiple long-term signals point in the same direction at the same time as they appear to be doing now, it becomes difficult to dismiss as simple coincidence. Rising government debt, a cautious shift in Federal Reserve language, central banks quietly accumulating gold at record levels, and real yields moving in a direction that has historically favored precious metals. Individually, each of these signals might seem minor. Together, they form a pattern that many experienced analysts say deserves serious attention, not panic, but preparation. And that raises an important question. If history has shown again and again how informed investors respond during moments like this, what exactly does that preparation look like in practice? Throughout history, the investors who protected their wealth during uncertain times shared one common trait. They did not wait for a crisis to become obvious before taking action. They paid attention early, and they moved with patience rather than panic. This is an important distinction. Preparation is not the same as fear. Fear leads people to make rushed decisions, often at the worst possible moment, buying or selling based on emotion rather than understanding. Preparation, on the other hand, is calm and deliberate. It is the result of studying patterns, understanding history, and making thoughtful choices well before those choices become urgent. So what did that preparation typically look like in past periods, similar to this one? For many investors throughout history, the first step was simple: diversification. Rather than keeping all of their savings in a single form, such as cash sitting in a bank account, they chose to spread their wealth across different types of assets. This often included a portion allocated to physical precious metals, alongside other traditional investments. The reasoning behind this approach is straightforward. Cash and precious metals tend to behave differently under economic stress. When trust in a currency weakens, or when inflation rises faster than expected, cash often loses value in real terms. Precious metals, historically, have tended to hold their value, and in many cases, increase in value during those same periods. By holding both, investors created a kind of balance, a way to protect themselves, regardless of which direction the economy moved. This is not a new or unusual idea. It is one of the oldest principles in personal finance, sometimes summarized simply as not keeping all of one's resources in one place. Yet history shows that many people forget this principle during periods of calm, only to remember it too late once conditions shift. Another pattern among informed investors throughout history was a focus on physical ownership rather than paper promises. There is a meaningful difference between owning a paper certificate that represents gold and owning the physical metal itself. During periods of serious financial stress, paper-based assets can sometimes become tied up in systems that are themselves under pressure. Physical assets, by contrast, do not depend on any institution to hold their value. This is one reason many long-term investors have historically preferred direct ownership of physical gold and silver rather than relying solely on financial products tied to their price. Timing, too, played an important role, though not in the way many people assume. Few successful investors throughout history claimed to know the exact moment a major shift would begin. Instead, they focused on gradually building their position over time, rather than trying to guess a perfect entry point. This approach, often called accumulating steadily, reduced the risk of trying to predict short-term price movements while still allowing them to benefit from long-term trends. It is worth repeating that none of this is a guarantee. Markets are complex, and no strategy removes risk entirely. Precious metals can experience periods of little movement or even temporary declines, just like any other asset. The historical pattern does not promise a specific outcome. It simply shows how previous generations responded when faced with similar warning signs, and how many of them viewed preparation as a form of discipline rather than prediction. What set these investors apart was not luck, and it was not perfect timing. It was awareness. They paid attention to the signals available to them, they understood the lessons of history, and they made steady, thoughtful decisions rather than reactive ones. Today, as the Federal Reserve's language shifts, as central banks continue accumulating gold at record levels, and as real yields move in a familiar historical direction, many analysts believe the country may be approaching a similar moment once again. The final question, then, is not whether history is repeating certain patterns. The evidence increasingly suggests that it may be. The real question is what comes next, and how this story is likely to unfold in the months ahead.